Well, we got to talk more about that prevention because to help make sense of just how long the market's upward trend will last, plus much more, we're joined by Andrew Sheets, who's the Chief Cross-Asset Strategist over at Morgan Stanley. Andrew, great to have you here with us this morning. Perhaps we can actually pick up where we left off because it is still the looming question of whether or not the banking crisis is over.
So I think when we are considering the pressures facing the banking sector, I think we moved away from a crisis element of that stress. I think the regulators, the officials have acted very aggressively to inject liquidity into the system to address the immediate shocks to the system. In that way, I think we're dealing with something that's very different from, say, what the banking sector faced in 2008. What it's still facing, though, is a longer, more drawn out question of greater conservatism, because I think the events of the last several weeks have given enormous incentives to banks in both the US and Europe to be more conservative with capital, to be more conservative with funding, to pull back and tighten their lending standards. And that tightening of lending standards was actually already happening before these more recent events. So it would further encourage that trend. So I think the way investors should think about this is that we're not going to have, or it's much less likely that we'll have kind of an immediate shock from these events, but the impact is going to be long lasting. It's going to hit with a long and variable lag, and it is going to likely result in weaker growth than we would have had otherwise.
I guess the question that we're all grappling with is how much weaker growth, right? And that's something that Jay Powell is obviously grappling with too. He alluded to that they're trying to figure out, is this equal to 0.5% in interest rate increases, right? And that's not something that we are yet able to quantify because of the long and variable lag you were discussing. But given that information is still outstanding, how do you strategize in the meantime? How do you try to sort of game it out?
So I think that's exactly the right way to put it. We actually have these two large headwinds for the economy, these two large challenges for the economy, the most interest rate hikes since the early 1980s, and then this situation in the banking sector where banks were already tightening lending conditions much more than they do during kind of a normal slowdown. And then you have events that would seem to encourage them to do that even more. And yet the impact of those tighter lending standards, it's not going to show up in the data for several months at a time when the full impact of rate increases is not going to show up in the data for several months. So I think as an investor, I think the way to think about this is to think about, what regime are we in? What sort of patterns of performance does this sort of economic data, this pattern of data represent? And I think the data remains very consistent with an environment where a hot economy, an economy with a healthy labor market, high inflation, low unemployment, is slowing rapidly. And that sort of deceleration has been at the core of Morgan Stanley's economic forecasts. I think that's very consistent with some of the trends that we see coming out of indicators like bank lending or like the index of leading economic indicators. And I think these recent events, unfortunately, only encourage the idea of a growth deceleration. So, from our standpoint, it's welcome that we've had a nice bounce in equity markets, over the last couple of weeks. I think this is an environment where ultimately investors want to use these opportunities to be more defensive, to rotate more into high quality fixed income, government bonds and investment grade bonds. And I think that is a type of strategy that is going to be rewarded and is often rewarded when growth is decelerating as we expect it to.
You mentioned that it wouldn't show up in the data for a couple of months. And so with that type of lag, does that mean that we could very well be experiencing perhaps the early phases of a recession before the Fed initiates some type of pause or a pivot?
So I think that's exactly the risk. And this is hard for the Fed. This is a really difficult thing to weigh. Inflation is a lagging indicator. Jobs data is often a lagging indicator, by which I mean it often turns and moves later than other forms of economic data. And the Fed is in a very difficult position where inflation data, the most recent data we have, was still relatively strong, was uncomfortably strong. And yet there are also these other elements that are affecting the economy, bank credit, the effect of the rate hikes they've already done, they're hitting with long and variable lags. And so I think there are a couple of takeaways. First is I do think this puts pressure. This makes the Fed's job difficult. It's not obvious to lower rates. it creates some risk that the Fed is not going to be able to be as dovish as the market would like as quickly as they would like. And the other thing I would note is that when I think it comes to interpreting what the Fed will do, more rate cuts from the Fed is not always better. If we think about some of the best market environments that followed Fed interest rate hikes, something like 1995 or 1997, 1998, those followed relatively small reductions in Fed rates, consistent with just kind of tapping the brakes a little bit or tapping the gas a little bit, moderating that. Whereas when the Fed has cut a lot, and currently the market is expecting the Fed to cut a lot, that's been more consistent with some of these more difficult market environments. So even though in the short term, I think the market wants the Fed to ease more, I think as an investor, a scenario where growth is a little bit better than we expect, but that means the Fed eases less, I think that would actually be much more consistent with better market returns.
Yeah. In other words, be careful what you wish for in terms of these cuts, Andrew. Finally, I want to ask you, because you look cross-asset, right? And you talked about some of the places that you're looking right now, but I wonder if there's something that you think is sort of being overlooked that to you, I always hesitate to use the words screaming buy, but right, like something that's super attractive right now that you think is not getting enough love.
Well, we think stocks in Asia are attractive. If I think about the reasons why we're cautious on developed market equities, it's a function of relatively high valuations, decelerating growth, high inflation, lots of central bank rate hikes, and then all of those rate hikes making cash a pretty attractive competing asset to some of these markets. Those statements don't apply in Asia. Asia generally has much more reasonable valuations. We think its growth accelerates this year. Inflation in Asia is much lower. Central banks across Asia are not nearly as hawkish, and generally cash in the region yields a lot less. So, we think this is an environment where in our hierarchy, we think emerging market equities are most attractive. A number of the large Asia markets, China, Korea, Taiwan are large portions of that. Japan would be second in that pecking order. And we think both of those markets are more attractive at the moment than stocks in the US and Europe.
Andrew, really interesting stuff. Thank you so much for joining us this morning. Andrew Sheets, Morgan Stanley Chief Cross Asset Strategist. Thanks.